Welcome back to another lesson at AllGen Academy. So today we're going to discuss another topic that's important when it comes to managing a portfolio, and that's the subject of rebalancing. In the previous lesson, we talked about diversification and why that's important towards long-term returns. Today we're going to delve into rebalancing, another element that's very important when it comes to managing your portfolio and your risk over the long term. So let's jump right in. Jason, what is rebalancing?
Yeah, so rebalancing basically is bringing your portfolio back to its target asset allocation, okay? And so you're doing that by selling assets that went up and you're buying assets that went down in your portfolio. And let me give you two examples to help explain. So in example one, we have a 50-50 portfolio, a balanced portfolio, 50% stocks and 50% bonds, and it starts that way at the beginning of the year. Stocks go up 20% throughout the year and bonds remain flat. So at the end of the year, your stocks have you're up to 55% stocks, where your bonds are down to 45% stocks.
If that were to happen.
If that were to happen, that's right. Which means the portfolio takes on more risk at that point because you have more stocks than bonds. Let me go to example 2 here. So in this scenario, stocks drop. So same thing, starts off at 50% stocks, 50% bonds. Stocks drop 25%, bonds go up 5%. So at the end of the year, your stocks are now down to 40% and your bonds are up to 60%.
Of the whole portfolio.
Of the whole portfolio. So that is taking on less risk now going forward. So back to example 1. Now, this is a scenario, and let's say you went through an extended period of time where stocks went up a lot, okay? And because of that, they became a much bigger piece of the pie. And let's say they got up to like 70%, for example, and then you never rebalanced, and your bonds were at 30%. Well, if that was to happen, and inevitably at some point, the stock market ends up going down and goes into a bear market, you could potentially, your portfolio would go down a lot more,
right.
And especially a lot more than a typical 50-50 kind of balanced portfolio.
Right.
And in the other side, back to example 2 here, let's say you go through a really bad time in the stock market, like a financial crisis, or 2000 through 2003, where the market took a pretty big hit, and your stocks became 30%. And your bonds were up to now 70%. Well, now your portfolio is taking a lot less risk. In fact, it's considered a conservative portfolio at that point. So when stocks inevitably rebound and you only have 30% stocks, now your stocks won't go up as much. Your whole portfolio won't go up as much. So it impedes you from recapturing some of those losses. So and when you rebalance, you're bringing it back to that target asset allocation. And what you're trying to do is not only reduce the risk, right, but you're also trying to improve the returns over the long run.
Right. So rebalancing, one important aspect and purpose of it is to make sure that your portfolio stays aligned, as you saw fit or needed, your plan says you needed based on your risk tolerance, right. Because it could hurt you both directions, right. Either becoming too risky or too conservative, right, taking you out of line for your financial plan.
Yep.
But another thing we've seen is that rebalancing, purposeful rebalancing, takes a piece of the investing equation out of it, which is something we've said is very dangerous, which is the emotional side of investing. Talk to us about that.
Yeah, so rebalancing, if done properly, it's really a systematic way of buying low and selling high.
Right.
Okay, and everyone talks about buying low and selling high as kind of the secret to making money in the stock market, but studies have shown people usually do the opposite.
Right.
So people usually buy when the stock market's going up, and they usually sell when the stock market's going down.
Or anything else. When real estate is high, it's going up. You buy real estate and you get rid of it when it's tanking.
That's right. So this creates a way where it's systematic, and kind of a lot of times automatic, so that you automatically sell stocks when they go up, or you automatically buy stocks when they go down.
Right.
And that's the case with all the different asset classes. So, which, like I said, over time, reducing risk, but potentially even improving returns over time. And let me show you an example of this over time. So this is just taking a 60-40 mix. All right, it's going back to 1986 through 2010, so almost a 35-year period here. And we're looking at the blue line, which is the rebalanced portfolio, and then the yellow line here is the unrebalanced portfolio. Okay, so
this one's rebalanced every year.
It's rebalanced, yep, every year, beginning of the year. Okay, so you can see here during the really good times in stocks, like the late 90s here, the unrebalanced portfolio actually started doing a lot better as the stock market was really strong during that time. And what you can see, this chart in the bottom here shows the percentage of equity. So remember, they both start off with 60% equities, but as stocks continue to go up, that 60-40 portfolio turned into an 80% stock and 20% bond portfolio after the late 90s when stocks went up a lot. That now is no longer a kind of what we would call a moderate portfolio at 60-40, but it's almost a moderately aggressive kind of growth portfolio. So when the stocks took a big hit from 2000 to 2002, they dropped a lot more. Okay, same thing happened from 2003 to 2007. It went up a lot. And even the unrebalanced portfolio started to catch back up again. But in that financial crisis, you can see the rebalanced portfolio fell a little less than 30%, whereas the unrebalanced portfolio fell 37%. So at the end of the whole period, the rebalanced portfolio had was up to $97,000 versus the unrebalanced portfolio at $88,000. So over time, even though it held some less stocks a lot of times, which people would think that you wouldn't get a better return with less stocks, because it took away from some of that volatility and it reduced the losses on the downside by staying within that target of 60-40 and not allowing your stocks to get too high right before the market drops, you were able to have a better return over that long period of time.
That's right. Now, understand, this is, obviously a simple example of stocks, bonds. There's a lot of other asset classes, right, if you're using them that you would need to rebalance as well.
That's exactly right. So, this just shows stocks and bonds. You have other asset classes like, we went over in previous lessons, like alternatives, where maybe there's gold or maybe there's real estate through the REITs, or even going in deeper, you have, large cap U.S. stocks, small cap U.S. stocks, you have international stocks, emerging market stocks, you have different types of bonds.
Value, growth.
Value stocks, growth stocks. So, if you, this is just a really simple example, but if you were to rebalance all those asset classes over time, you even get greater benefits of rebalancing. And a simple way to apply this is a lot of times different 401ks will offer an automatic rebalancing. So a lot of times 401ks are sometimes some of the people's biggest assets. And if you're not careful, in a good time, your 401k can become, take on more risk. So that when the market's drop, it ends up falling more, but you can turn on sometimes an annual rebalance, or sometimes a semi-annual rebalance, or a quarterly rebalance, where it brings all of your percentages of all your different mutual funds back into alignment with your target asset allocation.
That's right. So that's a critical component of this. And again, we're not advocating that a 60-40 is the best mix, or 70-30 or 80-20. It all depends on what your risk tolerance is, your time horizon. But the importance of rebalancing really becomes a critical piece of managing your portfolio to have it do what you want it to do at the long term. We saw this, right before 2000 when all these 401ks had exploded and people had not rebalanced, so they ended up with a large equity position right before retiring. And all of a sudden we saw that in 2000 when it crashed, people weren't able to retire because their rebalancing hadn't happened. They had a lot more risk in their portfolio than they needed to have.
That's exactly right.
Okay, so at the end of the day, we want you to understand that rebalancing is a systematic way to grow your portfolio with less exposure to risk over time and with more alignment to what you need the portfolio to do according to your financial plan. So thank you for watching. We look forward to seeing you in the next lesson.